All right. Well, good morning, everybody, and welcome along to clients and friends of the Escala family. We hope you're all keeping well. And for our Victorian residents, we hope that you can now start to see the light at the end of the tunnel, and hopefully we'll start to see the easing of restrictions in the not too distant future. My name is Derek Kennelly. I'm an investment analyst here with the CIO team in Escala Partners, and I'll be hosting this morning's session. The topic of today's discussion is centered around infrastructure and the role it can play in your investment portfolio, and how it can add defensive characteristics to your portfolio throughout the cycle. The infrastructure landscape is one that is ever evolving, and so we'll spend some time today looking at one particular area of the universe that is gaining significant momentum at the moment, and that is renewable energy. Before I do that, I'd like to take the opportunity to introduce Richard Elmsley. Richard is Managing Director, co-founder and Senior Portfolio Manager with Rare Infrastructure, and has over 30 years of experience in the infrastructure industry, and has significant global experience in the industry, working on areas such as the privatization of UK electricity, the privatization of some of Australia's largest airports, and he'll be providing us with his valuable insights into the industry and renewable energy and how he sees the evolving landscape at the moment. Just a reminder, if you have any questions, please submit them through the Q&A function that you can see at the top of your screen, and we'll hopefully get to these throughout the session. And with that, I'd like to just say good morning to Richard and say thank you very much for joining us. Richard, why don't we begin with an introduction to your career? You've had quite a long and extensive career in the infrastructure industry, and you can also maybe touch on how yourself and your partner Nick Langley came to the concept of creating Rare back in 2006.
Sure. I'm sorry everybody can't see me. This morning, our electricity provider decided to cut all our power off and the internet, so I've come into the office, but pre this crisis we didn't have cameras on every screen, so you can't see me, but hopefully you can hear me. As Dara said, I started the business with Nick in 2006, and I'd been doing about 14 years in really unlisted infrastructure around the world. And we thought at the time that really large institutional investors were the only parties that were getting access to the infrastructure investments and the characteristics of those assets that provided very stable revenues and cash flows and dividends across an economic cycle. And at that time, we thought that the universe of listed infrastructure stocks had got sufficiently large that we would be able to create a portfolio that would be able to emulate the type of returns that the big infrastructure institutions were achieving, but do it on the listed market. That meant that you got a little bit more short-term volatility, but you also had liquidity. But over the longer term, and these are all long-dated assets we enter into, the returns and the risk should be very similar. It doesn't really matter if it's in unlisted or listed. Over the long term, the returns and risk are similar, because these assets that we invest in tend to be regulated or have long-term contracts, and that applies whether it's in a listed form or an unlisted form. And so when you think about the assets that we're investing in, there's many different forms of infrastructure, but we're really focused on assets that provide pretty stable revenues across an economic cycle. And those revenues are stable because they're either underpinned by regulation or long-term contracts. And that means that our asset groups are really split into two areas: regulated assets that most people associate with gas pipelines, electricity wires and poles, and water pipelines, and the other ones are the user pay assets. And if you think about the regulated assets, these are companies that are regulated monopolies. The regulator will tell them how much they can earn, and if they earn too much, they need to give back some to customers. If they don't earn enough, but they've been a well-run company, then they can apply to have their prices increased. And the regulator doesn't really care how much energy or water is transported across the network, just that the poles, the wires, the pipes are in place and are connected to the grid so that the consumer can access electricity, water or gas. And so these assets generally don't carry much business risk. You get a return on your asset base. So providing the asset base is growing, you'll get a return. And depending on where the assets are located, the return can be a real return or a nominal return. The user pay assets, on the other hand, these assets are infrastructure assets that really are associated with moving people or goods around an economy. They generally have a pricing side to the business model set by regulation or a concession contract, but they are exposed to economic cycles. So if you have rising GDP and people are employed, they probably feel more comfortable using a toll road. But as economies come off, like we've seen in this downturn, and unemployment goes up, people probably aren't going to use toll roads as much. In this downturn, clearly you can't fly as much either. So these assets tend to be toll roads, airports, ports, rail assets, and some communication assets. But between the two of them, our universe is around 200 companies, and they're assets that exhibit these very stable cash flows. They have very good inflation protection. They generally have very good downside protection, and you capture a lot of the upside in the market. And they have a lower correlation to global equities. So with that background, I might turn to the first page on the presentation. So what we're looking at here is I just wanted to show you the stability of the earnings. So we're looking at EBITDA, earnings before interest, tax, depreciation, and amortization. Of the blue bar is listed infrastructures, it's a universe of listed infrastructure, and the green is global equities. And you can see in severe downturns, 2001, 2008, 9, even in 2012 and 2015, global equities EBITDA actually fell negative, whereas infrastructure, the earnings of these companies may have come back in those times of recession, but they were always positive, and they were actually pretty stable. If we could move to the next page, please. I also wanted to show you the very good downside protection you get from investing in listed infrastructure. And this is looking at our US utilities versus the S&P from 88 through to 2020. And you can see in that period of 2007 to 9 where the market came back and US utilities came back, from top to bottom, the utilities only fell 27% maximum, whereas the S&P fell 51%. And the recovery was only 21 months for utilities before it got back to the previous high, whereas for your global equities, US equities represented by the S&P 500, it took 5.5 years to recover to the previous high. So those resilient cash flows meant that initially investors probably panicked and sold a lot of stocks, including utilities, but actually when they sat back and thought about it, those stocks still had very good cash flows and were paying dividends, so investors went back into those stocks, and that's why it recovered relatively quickly compared to equities. And again, we had a similar situation this year where it fell 10.4%, so it was a quick fall, almost as much as the S&P, but it came back very quickly. And this occasion, so did US and global equities. If we just move to the next page, I wanted to show you that the dividends are very stable and they tend to be growing. And you can see here the dividend profile of US utility stocks from 1980 to 2019. And during the GFC years, the dividend per share increased 6.2%. And for the 10 years post then, it was growing at about 5%. So I mentioned to you that for the utility stocks, the regulated stocks, and that's what we're looking at here, you get a return on your assets. And in America, because there's been a very high incentive to build renewable assets and to reinforce the transmission lines, the asset growth of these companies has been 5 to 8%. So I've got my assets growing, so my return is growing, and you've been getting a nominal return of 9 to 10%. So you've got an asset growth of 5 to 8 and a nominal return of 10. That's very attractive, and that has meant that dividends have also been growing over this period. And actually, that profile I just suggested to you, we don't actually expect to change in the period looking forward. If we just turn to the next page, please, and I have a look at some of the user pay assets here. Here what we're looking at is regional roads and intercity roads and air travel. And what happened this year with the crisis was that everybody was told to stay at home around the world. Air passengers were not able to, or people were not able to fly. Domestic cars were not driving because people were at home, although we did have truck traffic. And we saw a dramatic fall very fast in passengers on the roads and in the airports. And in fact, prior to this crisis, no one really would have expected that an airport's revenue would drop 98%. The inner city roads that like Transurban have, are going to recover first, and we think roads are recovering, and they've recovered very well over the last 6 months. But air travel, it's going to take a number of years. Most people expect probably out to 2024 before air travel really gets back to where it was. We can all run different scenario analysis, but it's going to be a long period before air travel comes back. And probably the best air travel is domestic, where you get a bubble. International air travel is really dependent on governments opening up their boundaries and their countries for travel. And for many countries, that looks a while off. If we just have a look at specifically maybe Transurban on the next page, you can see the share price of Transurban fell dramatically in March as a consequence of COVID, down to about $9. To be frank, on a valuation basis, because these are long-dated assets, it doesn't make a huge difference to your valuation. What was really important to us back in March for these user pay assets was to make sure they had enough liquidity to see themselves through this period, to see whether they needed to do capital raisings, which we've observed with some of the airports around the world, and to see whether they were going to cut dividends. So we did some very thorough analysis on those 3 areas back in March. But in respect of Transurban, you can see there that in the March-April period, traffic was off 50%. It was down 20% in June and down 5% lately, although it's probably a bit higher because of the Melbourne lockdown, so it's probably closer to 10% now. But we expect Transurban to come out of this quite well. They've got a number of projects that are opening. The M8's open, North Connex. They've got a very strong pipeline where they're buying 49% of WestConnex. They've got the Western Tunnel, Maryland Express lanes in America. So they've got a lot of projects on the go. They have very solid cash flow. They have reduced their dividend slightly. It was running at 5%. It's about 3.5%. Given a lot of their cash is going into building these new roads, they need to conserve some cash, and that's why the dividend came back a bit. But as these roads come on and the cash flow starts flowing, we would expect dividends to increase quite rapidly from 22 onwards. I will point out that when the stock fell to $10, Rare was a buyer of that stock, because on our valuations, that was an extremely cheap point to buy. And as I said, a blip like this, when you're valuing 20 years of cash flows, doesn't make a huge difference to valuation. So if you've got live models, it's very easy to take advantage of that, and that's what we did for Transurban. And if we just flip to the next page and we have a look at airports. So around the world, it's been a complete disaster for airports. Most airports around the world, revenues have fallen 95, 98%. Today, airports still have very substantial reduction in revenues, and it's going to take many years, as I said, for revenues to come back. It's likely domestic revenues will come back first, and then international revenues. We've seen the share prices of airports around the world fall very, very significantly. Pure airports, you've got the airport in Paris, there's 4 airports there, ADP, they own a number of other airports. But as of a few weeks ago, their share price was down 51%. We have Sydney down 36%. Spanish airports down 30%. Auckland was down 24%. Very large reduction in the airport valuations, mainly because of there being no revenue. Now, it's interesting, I said Sydney was down about 36%. Some of the unlisted assets have fallen, but they haven't been revalued down as much. I noticed that AMP, which has an interest in Melbourne Airport, devalued its asset by 15%. You're comparing that to Sydney, which is down 36. So one could argue Sydney's fallen way too far, or maybe AMP should have written it down a bit further. But the listed assets do look very cheap compared to some of the unlisted assets. In terms of the financial outlook, everybody's aware that Sydney raised $2 billion recently. Our view was that probably Sydney had enough liquidity to see it through to the end of next year, but there was a lot of market pressure on the company to do a raising, so they've done that. So they have no debt refinancing until 22. They've got enough cash to see themselves through this. Hopefully domestic travel restarts this year and international travel next year. Sydney Airport is a phenomenally well-run airport when it's operating at capacity, but on our numbers, we think it won't get back to the 2019 levels till 2024. They've done the right things, reducing CapEx, reducing OpEx. They suspended dividends this year. I suspect at the back end of next year, if travel comes back, we'll see a small dividend being paid out. But the really key things that will determine how quickly it comes back is when domestic travel really opens up in New South Wales to other states, and when international border restrictions are lifted so that people can travel. But there have been some structural changes. Business travel may not be as much. People have got very used to doing Microsoft Teams or Zoom meetings. And I think people are still going to be a bit skeptical of COVID. And the other thing is for Sydney, there is a big impact on older people. More than 10% of the passengers that go through Sydney Airport are over 65. And some of that group may be hesitant to travel initially until we're really sure the vaccine works. So I'm pretty comfortable that this asset will return to the levels we saw in 2019. The question is when. We've modeled different scenarios. Our base case is that it won't be back till 2024. But I will say it's a very attractive asset in normal circumstances, and these are extremely unusual circumstances that we're in at the moment. If we just turn to the next page. So this is looking at consensus earnings in 20 and 21 for different asset classes within our infrastructure universe. And I might just point you to the left-hand side where we're looking at airports. You can see that there's quite a wide range that the analysts are saying for airport earnings. And that's because people and investors and analysts are not really sure how quickly they're going to recover. And whereas if you look at the other side on the utilities on the right-hand side, because of the regulation, there's a higher degree of certainty of what the earnings will be, and there's not a great dispersion between what analysts think. And in fact, if I go back to March, when we were looking at some of the figures, and I compared an airport, for example, ADP, which we were talking about, I was mentioning the French airport. In December 19, analysts thought it would make 1.9 billion. By February 20, it was 1.8 billion. By March, it was 1.4 billion. By April, it was 1 billion. It just kept coming down and down as this crisis got worse. But if you look at a utility like Terna, which is the monopoly electric utility in Italy, in December 19, analysts thought that it would earn 1.7 billion. And in April 20, analysts thought it would earn 1.7 billion. That just shows you that there's a high degree of confidence in those utility earnings, whereas the airports, it was very difficult to tell. Toll roads similarly, but the dispersion's not as great. Renewables the dispersion was very close because again they have long-term contracted revenues. So the main point to point out here is the infrastructure stocks. It is more difficult to determine with precision next year, the year after, exactly what the earnings are. We can all run different analysis on what they are. We can make an assumption when it returns to normal. And I think most people are on the same page there for airports. Most analysts are saying 2024. Toll roads are coming back very rapidly around the world, and as more of us return to work, that will continue with the domestic passengers. The trucks are still doing significant traffic around the world. we just turn to the next page. This is looking at dividends, and obviously our income strategy, part of our construction is to assume that we can provide investors with a dividend of over 5% or greater through a cycle. And that strategy has been up since 2010 and has achieved 5% dividend in each of the last 10 years. We did some very detailed analysis, as I mentioned, on cash flows and dividends of all the companies that are in both the value strategy and the income strategy to determine whether we thought dividends would be cut. If you look at this page here, we're looking at the income strategy, forward-looking dividends 1 year. Really, the only areas where dividends were cut were airports. All of the utilities, in fact, dividends stayed pretty stable. There was a slight increase for some companies, but in general, the dividends, we had to cut them back a little bit. As you can see there, came down by about 0.4%, but were pretty well intact except for the airports and one of the communication companies. So we just, I might turn to renewables now. Renewables seems to be the theme this year, but has been growing significantly over the last few years. We're fortunate enough that in our universe there are a number of renewable companies that are listed. Some of them are very large. But renewables are going to be a very large percentage of generation in the future. Today, renewables, which is primarily wind and solar, are about 25% of global generation. But if I go to 2050, it is expected that they'll be 86% of global generation. And if Biden gets in, he's going to push America much faster. I assume they'll rejoin the Paris Agreement, and that might push us a bit faster than 2050. By 2050, there's expected to be about 42 million people working in or associated with renewable energy. So it's going to be a massive area to be in. The growth in renewables and I guess the consumer's desire to have a more carbon-free world means that these companies, as they grow, are becoming more attractive in value. And you can see that the contracted renewables there in the blue line, our forecast equity value from June 18 to 23 has been increasing. Now, this is at the expense of some traditional companies. When you look at a pipeline, and that's the orange line there, you can see what the values came off from 19 down to 20. They're increasing, but our view is that pipelines which carry oil or gas, traditionally you'd value them for 40 years, you'd have a terminal value at the end of 40 years, and you might assume that terminal value has some growth in it, 1 or 2%. We are coming to the view, we came to this view about a year ago, we think that terminal value growth rate is probably wrong, because we think there'll be less oil and less gas traveling through pipelines in the future. That means there'll be less capex into pipelines, apart from the fact environmentally it's very difficult to get a new pipeline up these days, but even the existing pipelines, we think the capacity will come back, and therefore pipelines are not going to be as attractive, but we're going out 40 years, but we think eventually, or probably short term, investors will start to realize that. We might be a bit early, so we have actually sold down most of our pipeline exposure because of that view, and we have quite significant exposure in both strategies to renewable companies, 15-17% of the portfolio. I should say coal is still going to make up a large portion globally, because countries like China, they have like 150 megawatts of coal under construction. So that's going to be around for a while, but definitely coal's been on the nose for quite a long period now. Gas is not carbon friendly, but it is going to be the fuel in between. Coal will go first, and then probably gas will cut back as we get more solar and we get more wind coming in. And in fact, in the United States, in California, one of the towns has come out and they've stipulated that all new build homes, I think from 2022, cannot have gas connection, only electricity connection. And I understand somewhere in England, they've done a similar type strategy where they have said that gas cannot be connected into the homes. So this trend is going to continue. It's going to build in momentum. If we're able to capture some of that value by investing in these companies, it's a high growth area. Might turn to the next page and just have a look at, so NextEra Energy Partners, based in Florida, $5 billion company. Its parent is the largest utility in North America. Its parent is very focused on renewables, solar and wind in Florida and elsewhere in America. You can see there that its share price fell quite dramatically in March along with everything else, but has recovered. We first bought into NextEra, which is primarily a renewable wind and solar company where they have long-term contracts, which sets the price that they can get for the amount of wind that they can dispatch in any one year. So we have very high certainty over those revenues and dividends. We first went into this company in 2015. We bought some more when it fell in March. We had a live model, it looked very cheap. Initially, we bought some at about 45, but we managed to pick some up at 32, which was near the low. We think it's a very attractive company. It's got tremendous growth. Forward yields about 4.3%. You can see the DPS is growing at about 15% through to 24, which matches the growth in earnings. Renewable capacity is expected to increase by over 50% in the next 3 years. And as the bottom line says, if we look at our bull scenarios, we can see significant value being added to both NextEra Energy Partners and NextEra's equity value over the next 5 years. And in fact, we're an investor in both. If we look at the next page, this is a company called Ørsted. It's a Danish company. It used to be predominantly in fossil fuels, and they made a decision a number of years ago that that was not the future, and they wanted to be a pure play renewable company. And today they've got about 30% global market share of wind ex-China capacity. As I said, they've gradually exited their oil, gas, and coal business. 90% of their earnings come from long-term contracted based or regulated activities. And they're very dominant in Europe, and they're looking at the opportunities in North America at present. We invested in, first invested in Ørsted earlier this year in February at about 683. Took a 2.5% position. In hindsight, we probably should have taken a higher position. We bought a little bit more through that. It's going to play an important role in the portfolios. They're expected to be 100% producing just green energy by 2025. And they, as I said, they're now expanding from Europe into North America. We think it's a very attractive company. It's got a market cap of about 60 billion, so it's very large. It's got significant growth in its EBITDA or its earnings at 20% a year through to 2025. And now a lot of that cash is going back into new projects, so it doesn't pay a higher dividend as some of the other renewables. But and again, if you look at the optimistic scenario here at the bottom there, on our bull case, we can see an increase of over 40 billion in equity value if they're able to capture some of the projects that are up around the world. So I think the point is renewables are a very large theme at the moment. We are able to capture some of that theme in our portfolio and have been doing so since 2015 and more seriously over the last 2 years. If I move to the next page, just have a look at the income fund. The income fund's performance has been very good on a relative and absolute basis. You can see there since inception, that's since 2008, it says. I think it's actually 2010. That might be an error. We better check that. But over a 10-year period, it's done 11%. Obviously, income's been flavour of the month for the last 3 or 4 years, but we expect to be able to obtain a very good total return for investors and to provide that dividend return that people are seeking today, particularly with interest rates so low. As I said, we're aiming to provide a dividend of 5% a year. We've managed to do that for the last 10 years. We look forward out 2 years and we still believe we're able to do that and achieve a good total return for investors. And if we look at the next page, I just wanted to give you an idea of the portfolio. If you look at some of those key stats, these are big companies. The average market cap is $25 billion. The forward-looking yield today is about 5.1. The growth in that yield is 4%. Gearing is the look-through gearing of the companies. The fund itself is not geared. 43%, not unusual because you've got a lot of utilities there that are regulated, that provides stable cash flows, and as a consequence, the regulators allow them to have slightly higher debt. If you look at the sector exposure there, the way we can get a higher dividend is by investing in more of those essential services, gas, electricity, and water, because they tend to pay higher dividends than the infrastructure companies, the airports and toll roads. We still have some exposure into the airports, despite the fact that they've cut their dividend this year, and that's why the forward dividend's down a little bit. They're very cheap. We had the exposure before them being cut because they were paying good dividends until this crisis, which, to be frank, we'd been telling investors since into 2018, start to get defensive. There's no way that anybody would have perceived an airport's revenue being cut by 98%. The assets are still very good. That portion of the portfolio is not paying a dividend this year, but we're still able to get over 5%, and we would expect dividends from that portion of the portfolio to come back. On a regional basis, about 37% in North America, 34% in Western Europe and Asia. And we have about 17% of the portfolio in renewables, and there's about 15% in Australian stocks. So, and then just look at the last page. We do a forward-looking IRR on the income strategy. Clearly, when stocks fell in March, the forward-looking returns looked far more attractive because for our stocks, the earnings were still there, just the share prices came back. It got to about 14%. We're still seeing a forward-looking return of high 11s. That's still very attractive. That's on a 5-year basis. This has been a reasonably good predictor of what the forward returns look like. You can see they moved around as stock markets and prices move around, but even though the stock market prices move around, the underlying cash flows of the companies we're in really have stayed very stable despite stock markets going up and down. The cash has been there, the revenues have been there, and that's what you're really investing in. You're investing in companies that you've got a high degree of confidence, revenues will be there, cash will be there, the dividends will be paid, and you'll get reasonable capital growth over an economic cycle. So that's really the conclusion of my formal part of the presentation. And are there any questions or?
Absolutely. Thanks a million, Richard. I think that it's a fantastic rundown and especially a really good introduction into renewables and the growth we've seen in recent years. When we talk about renewables, a lot of people seem to think that, you know, Europe is kind of out by far and away at the front of the pack when it comes to investment spending on renewables. How are the other major regions looking at renewables? Have we seen the sort of investment that's been flagged by Europe in other areas?
Yeah, look, Europe's very public, but so is North America, to be frank. I think when Trump got in, and everybody knows he's pro-oil, when he came out and said, I'm pro-oil, I'm going to cut out of the Paris Agreement, I don't want to be in renewables, many of the states were already in renewables. I think they put their back up and said, we're going to double down. So if you take California, which is the 5th or 6th largest economy in the world, they want to be carbon neutral by 2050. I think 2050, 2045, 2050. New York wants to be carbon neutral by 2040. Joe Biden's come out and said 2035. Now, that might be a bit ambitious to get that done, but what you've got is about 21 states in North America that are very pro-renewable energy and have been putting in tax incentives to make sure that the capital's going to renewables. So we don't have it across every state. if Biden gets in, that will be very healthy because he will put a platform over all the states that provides high incentives for capital to go into renewables. So we'll see a higher growth there. And for us, there are more listed companies focused in North America than there are in Europe. In Europe, there are three big companies. Ørsted, I mentioned, is just pure renewables. There's a company called EDP Renewables, which is owned by EDP out of Portugal, but they've got a very large renewable base in North America. And there's Iberdrola, which is an enormous Spanish company with operations in Scotland, England, Spain, and North America. And through their North American business, Avangrid, they have quite significant exposure to renewables. So with those incentives in place, and to be, just so everybody knows, you don't really need incentives in North America for wind today. Wind, with the current incentives, wind's going at about $12 a megawatt hour, which makes it the cheapest source of electricity in North America. But if there was no incentives, it's about $30, which means it competes with gas generation. Solar still needs incentives. It's about $50, but with incentives, it can compete. So, and we've seen the price of solar cells come down dramatically and the efficiencies of the cells improve dramatically. We've seen investors like Elon Musk invest heavily into batteries. Batteries are a very important part of this equation. We haven't traditionally been able to store power. If I can create the power from the sun and then be able to store it, it's a tremendous advantage. So I think there's going to be a lot more money going to batteries. We don't invest in that, but it's important. And there's going to be a lot more money going into renewables around the world. Biden will be a very big positive if America does really put its full support behind renewables. I think that will force other countries, including Australia, which I must say has been a disaster. We haven't had very good policy. Investors have built some renewable plant, and then what they found is the grid has said, well, I can't dispatch all your power, so I'm going to cut you off. So I thought I was going to make a 10% return because I'd be dispatching, and all of a sudden I'm not selling my power because I've been cut off. New South Wales seems to be trying to create these geographic zones for renewables, which will give them greater confidence that your grid will be able to take that power. But we're a long way behind on a global basis in Australia, and it'd be nice to think that we could catch up to Europe and some of those states in North America.
Yeah, I think Australia is one of many parts of the world that's realizing they are quite behind in terms of renewable investment spending, and to meet those Paris Agreement targets that they're going to need to significantly ramp up spending. You also you mentioned both Donald Trump and Biden there. So from a broader infrastructure outlook, what implications do you see from the November elections?
Well, look, if Trump gets back in, it might be better for the stock market, maybe pro-growth, but I actually think Biden coming in, he's going to put money in. He wants to spend money on infrastructure, so does Trump. They haven't been very successful in the past in North America spending a huge amount, but I think we might see more partnerships with private enterprise. Clearly, Biden's going to incentivize companies to spend an awful lot of money on renewables. Under either scenario, I think we're going to get quite good growth, which means that this sector will do well, infrastructure, but may not do as well as some other sectors that could benefit from the growth. But we think that the returns that we provide to investors, our goal is G7 inflation plus 5.5, and for the income strategy, giving the 5%, we'll be able to achieve that. I think there's going to be, in the short term, a fair bit of uncertainty at the moment. Some of the polls are saying Trump has moved up quite dramatically, and there's only really 6 states in North America that count in the voting. And we may see some volatility once the votes come in. If Trump's not happy, not sure what happens there, but that's short term. Clearly, if Trump, from our perspective, if Trump is successful, then investments in oil and pipelines might look a little better. But as I said, I still think pipelines are on the nose longer term, and we're valuing these assets over 40 years, not 4 years. So we're watching it. I mean, clearly there's a lot of stimulus in the economy set up by central banks, and there's a lot of fiscal stimulus as well by governments supporting economies, and that has a delayed effect. So it takes a while for that to come through. So I think we're going to see a lot of growth next year. I mean, short of COVID coming back in the second wave, and maybe it will because it apparently does worse in cold climates, but I think people have got used to it as long as the death rate stays down under either a Biden or a Trump scenario. I think we'll operate quite well. I think Biden would be better for the utilities, just because he's pro-renewables.
Thanks, Richard. Another area that's quite topical at the moment is inflation. And obviously you mentioned the defensive characteristics of the utilities and other parts of infrastructure at the start. Do you want to maybe just kind of run through how infrastructure can be a good inflation hedge throughout the cycle?
Yeah, sure. I think we're going to have inflation. It's pretty clear now the Fed is moving to an average inflation policy. So they used to have a target of 2%. I'm not sure if everybody on this call's aware that they're changing their policy. So they're saying we're happy for it to overshoot 2.5% to 3% for a period of time. So they want to get inflation back in, as long as over a period of time, I don't know if it's 5 or 7 years, it averages 2. So real rates are probably going to be negative. Inflation is probably going to pick up. For many of the utility stocks, the ones which are governed in Australia, England, parts of Europe, South America, you get a real return on the assets. So if you have inflation, it doesn't really matter. I'm going to get a real return. So I do very well in that environment. In North America, you get a nominal return, and you have to go back to the regulator and ask for increase in prices. So there's a lag. So if your cost of goods go up because of inflation, you may be short-term lagging, but you'll go back to the regulator and ask for an adjustment, and you increase your prices. If we've got inflation, we've probably got growth in our assets. We probably get growth in the economy. If we've got growth in the economy, there's more people driving on toll roads. Hopefully unemployment comes down as we get more growth. And what that means for toll roads, I've got more people on the roads driving, so I've got more revenue. I'll probably see rates rise a little bit, but our view is that rates are going to be pretty low for quite a while now. Governments themselves, because they've got so much debt, really can't afford interest rates to go up a lot because they couldn't service it. So our view is that rates will remain quite low for quite a while. But most of the assets that we invest in, their revenue goes up by inflation. So I might get a real return, but my revenue goes up every year by inflation or a portion of inflation. So this asset class provides very good inflation protection on the cash flows.
Yeah, very good. Just a reminder for anybody on the line, if you want to submit any questions, to do so through the Q&A function. Just one that's come through, Richard. If you could explain the difference between the value and the income strategies and the slightly different characteristics to both.
Yeah, sure. The value strategy, which was our very initial product in 2006, was set up to provide investors with reasonable capital growth and part of the overall growth making up of dividends. And we had expected the dividends between 3% and 6%, depending on where we are in the cycle. And that's basically what's played out. In 2010, we were approached by a client that said to us, or 2009, could you create a strategy where you can extract a higher dividend through the cycle and possibly a little less capital growth? And that was what the dividend strategy is. So it's exactly the same investment approach to looking at the companies, except we overlay that we want to achieve a 5% dividend distribution to clients each year. And so dividends are a secondary area that we look at with a much higher degree of focus in that strategy to make sure that the dividends are sustainable, that they're growing, and that at a portfolio level, we've got more than 5% being paid out. And that's the primary difference. To get to that 5%, it means that you're investing more in essential services, gas, electricity, and water businesses, your renewables, etc. You've got less exposure to infrastructure type stocks. As I said, infrastructure stocks, your airports, toll roads, ports, rail, they're more economically sensitive. I mean, they're less sensitive than a company that sells widgets because I can predict the cash flows with a reasonable degree of certainty, but their usage, cars on a road, people through an airport do come off in recessions. And are you there?
Yeah, we've got you, Richard.
Oh, okay, I've lost you, but it doesn't matter. That's fine if you can hear me. So they come off during a recession, but equally, as we move into a more bull market, you get more people, more goods moving through the economy, and so they do quite well. The value strategy will have a higher exposure to those infrastructure stocks. So as we come out of this economy, it's probably going to have higher capital growth, but less dividends.
That's a great synopsis. I think we might leave it there. We're pushing up against it time-wise. Richard, thanks a million. This will be a very interesting discussion, and I think it'll be obvious for clients to see why we like to have an allocation to infrastructure throughout the cycle. And renewables is clearly a theme that more and more governments and private clients are going to have to look at going forward. Thanks again, Richard. Really appreciate your time today. And for anybody on the line, if you have any questions, please do submit them through to your advisor afterwards and we can follow up with those. Thanks, Richard.
Okay, thank you very much. Bye-bye.
Thanks.